Hello and welcome to GTR UK. Can I initially thank GTR for putting on this event, and it's nice to be back to a bit of human interaction, albeit the four of us here and the crew. My name is Simon Philpin and my role is Head of Business Development for Markel International Trade Credit Division. And today I'm super excited to be moderating a fantastic panel of experts for you who will be providing their expert views on today's titled discussion, After the Storm, What Next for the UK Trade Credit Market. During this discussion, we will highlight how the pandemic impacted and insured from the automotive industry, how the insurance industry responded by interacting with the Association of British Insurers and the UK government to make a scheme available to help support continued trade, and also how the reinsurance market reacted to the scheme. Finally, we'll finish off with views on the outlook without the scheme, as we all know the scheme finishes tomorrow. I believe the viewers have the ability to ask questions. If we see them and we have time to incorporate, we will try. If not, we will get answers online later today or tomorrow morning. If I can now ask each panelist to introduce yourself with your name, your current position and the organisation you represent. And if we can start with right-hand side, please, Jane.
Good afternoon, everybody. My name is Jane Hull. I'm Underwriting Director for Tokio Marine HCC, working in the trade credit insurance line of business. Thank you for inviting me. Delighted to be here.
Right, so my name is Ava Rose. I'm one of the directors of the reinsurance side at Aon for credit and financial risks. And likewise, very pleased to be here and thank you.
Hi, everyone. My name is Rian Erding. I'm the Chief Financial Officer for McLaren Automotive.
Thank you. And we got Milo.
Hello, everyone. My name is Milo Bogaerts. I used to be CEO for Euler Hermes UK in Ireland, currently CEO for the Northern European region, and also here in my capacity as Chairman of the ABI.
Okay, and thank you all very much. And from myself, thank you for being here, everybody, for agreeing to be here. Okay, if we can start off, Rian, if we don't mind coming to you initially. McLaren is an iconic, well-known global brand, but like most industries, was not immune to the pandemic. Would you mind setting the scene for us and describe how COVID-19 impacted McLaren Automotive?
No, of course. Thanks, Simon, and thank you for the invitation to come here today. Well, I mean, I'd like to start off by saying that, clearly it's been a devastating time for everybody. So, it's, our experience is just our experience. And, I know that people have suffered greatly. But as you say, we weren't immune. The disturbance to the business from the introduction of COVID last year was really challenging. From a sort of a high level perspective, we lost 70% of our business against our plan during the year. So as you can imagine, that's material and significant. But the impact came in three forms, three large buckets, if you like. So the first one was then on the demand side. So what happened around our sales capability? Now, luckily, McLaren is a global company, and we have well over 100 dealerships spread around the globe. And around about March time, we noticed then that the Asian and the Chinese dealers started to close first. So that's when we realized something pretty significant was happening. And that was sort of early March 2020. Mm-hmm. But our European and our North American dealers remained open. But then as the pandemic started to roll around the globe, then we saw closures from our dealerships in Europe and then finally North America. So by the sort of Q3 of 2020, most of our dealers had been closed to some extent or other. Now that didn't mean that there was a complete shut-off in the customer journey, the customer sales, but as you can imagine, it curtailed it enormously. The second area was around then our supply chain. Now, obviously, you can't sell cars if you can't build them. And a lot of our suppliers, again, globally, were suffering from the impacts of COVID. So it meant our supply chain became disrupted quite significantly and our logistics line became very clogged. And again, as I say, without parts, you can't build cars. And then finally, there was around our production centre in Woking. Now, clearly, our first thought was for our staff and the well-being of our team. So when the first lockdown happened, we decided to close the factory for a number of weeks. And again, you can't build cars from home, so it meant that production stopped, and therefore we weren't able to meet the demand of the customers that we wanted to. So it was all in all pretty challenging.
Yeah. Okay. No, that's great. Thank you for that overview. Milo, I think it's good to come to yourself next. What Rian described there, you would have seen this across multiple industries with your role. And also as the chairman, also the chairman of the Trade Credit Committee of the ABI, can you describe the process of the committee in speaking to the government to put the scheme in place, and what were the scheme's objectives? Probably also taking into consideration the 2008 scheme as well.
Yeah, I think I will. Thank you, Simon, for this question. I think that indeed what Rian said is, I think we saw it across industries. And when we were around March last year, I think we were thinking as a Trade Credit Committee, we had the global financial crisis. And at that time, as a global industry, because there was a lot of uncertainty, what happened is we were thinking about how do we manage our own survival. And at that time, what we did is we canceled about between 20 and 25% of our cover. And that was only a global financial crisis, which led to a drop in GDP of around 4 to 5%. We were looking in March last year, we were looking at something like a drop in GDP of 10%. So you couldn't imagine what we thought what would happen and what we need to do as an industry to protect our own balance sheet. So what we said is, let's see whether or not we can go to the government and also help them to understand what the impact would be if we would take out 25% of our cover. And give you a bit of a background, I think the whole industry in the UK covers around 170 billion of exposure on companies, which is equivalent to 300 billion of turnover on an annual basis. Quite substantial. I always say I'd like to be some sort of intel inside. You don't know that we're there. That's the most important thing, but I think we're quite important to make the machine work. So that's something I think we went to the government, and in the first phase, we clearly had to explain what is credit insurance. What does it do? How do we manage our risks? How do we make sure that we are able to provide cover for the economy? And we said, and the importance for us is what we want to do is maintain as much cover as we can. So when the pandemic is coming to an end, or when the economy is opening up, that there's ample enough cover for the industries to start opening up again and delivering goods on credit. I think that's the most important thing. What always happens if we withdraw credit on a massive scale, you will have the knock-on effect. So, if you are not able to buy on credit as a company, that means that you need to resort to different resources, either pay cash or in advance, and that will often trigger a trickle effect on other insolvencies. So that's the government says, what we want to do is we want to protect our jobs in the country. Because if you cancel cover, you will have extra insolvencies that we don't want to. So basically, after 3 months of talking, they were able to come up with a proposal to put a scheme in place. We didn't want to have the same scheme as 2008-2009, which was a top-up scheme, which meant that every customer had to apply for a different limit. What we said is, for the customers, it needs to be a seamless process, it needs to be in place, and it needs to work well. So we managed with the government to come up with a scheme which was a reinsurance scheme, and reinsurance basically means at the back end of all processes, which is to protect us to go forward. And we came up with a good solution. And then we found a joint enemy in the European Union to get it across. So we were really collaborating together to get the European Commission to get an approval on the scheme. And in September we start executing, which was great. I think we hit it off well. I think we started off well. And in the next phase, it was executing what we needed to do. As usual, the government asked for quite a lot of proof that we've done the right thing. So we have a massive reporting requirement on a weekly and a monthly basis. And up to now, I think the goal of the scheme to protect as many jobs as we can, I think we've managed to do that. And today we had maybe to highlight, we had an ABI Trade Credit Committee where we also invited government to give a bit of a view on their takeaway from the government scheme they put in place. And they were very proud that they met all the goals which they needed to meet. I think it was they protected jobs. We have same levels of cover in place, so they were very happy how it went. So the thought process was don't interfere too much with customers. Make sure that you keep substantial cover in place so the economy can thrive as much as it can today. So that's about it.
No, that's great. Thank you, Milo. And on that ABI meeting this morning, I think the figure the government gave out was for the insurance going through that scheme was around about 570 billion for the whole period.
Okay.
So that's a substantial figure. Do you mind touching on, in terms of the discussions with the government, how collaborative with the government? Were they open to this, or was it a bit difficult to start with given their limited knowledge of trade credit industry?
No, I think they were amazing. What I honestly think appreciated is the level of intelligence and knowledge and collaboration the government had. I think they got a speed course in trade credit insurance in about 4 weeks. How does it work? How does it? And they did really well. And they came back to us with ideas how they could implement it. And I think it was basically, we had one goal. And for us, it was basically maintaining our levels of cover as much as we can. Maybe also to say, Simon, for the industry, it was a reason to go into this scheme because after the pandemic, we lost a lot of customers after the global financial crisis, we lost quite a lot of customers because we canceled so much cover that nobody wanted to stay with trade credit insurance. What's the value of trade credit insurance in these kind of times if you pull away so much cover? So for us, the interest was to be supportive, to be positive. And the common goal was, support the economy. So there we found our common ground, and it was quite easy to see how it's done. And then it's most of the time details, basically how much terms and conditions will we put in place to make sure that we, as insurance industry, stay honest? How much do we think the government should be taking place to make sure that we provide cover? And that went honestly on a quite collaborative basis. This morning they said, and that was true. I was on calls with secretaries and ministers on Saturday and Sunday morning, just to make sure that saying, if you don't do anything as an industry, we will act. So you needed to have that discussion. And they were willing to take a call and at 3:15 on a Saturday afternoon to move forward. And that was great. So that meant that they were serious and they were very, very helpful. So yeah, it was a very collaborative approach we had. And the main thing was that we had a common goal. I think that was the importance of it.
Great, thank you, Milo. Jane, it's probably a good time to bring you into the conversation. Obviously, not all insurers participated in the government scheme, and Tokio Marine HCC didn't participate, but Tokio Marine were not the only ones either. So it'd be good to get a thought process from yourself on the rationale of not joining the scheme.
Yes, of course. So firstly, I'd thank Milo and our other colleagues at competitor insurers. They did a fantastic job of working together. It was a huge amount of effort. There was lots of weekend working. And it was a really good example, I think, of the private sector working very closely with the government. So that was all absolutely fantastic. As Milo said, these conversations started in March 2020. And in March 2020, none of us really knew what was going to happen next. So huge uncertainty, very difficult to predict anything, difficult to know as an insurer, how to behave and how you could carry on through the pandemic. But actually, by the time the government scheme was in place and insurers were asked to sign up, we were in about, I think we were August 2020. And by then, we'd seen what the government was going to do in terms of propping up businesses from the ground up. And in fact, we think they did a very, very good job, and that support continues. And against that backdrop, everything became a little bit more predictable and there was less need to panic. So whereas on day one, something was needed to ensure the credit insurance market was able to continue, that picture started to change quite quickly. Now, if we go back to the basics of, why the scheme was necessary and reflecting back on the global financial crisis, it was to try and avoid a mass cull of limits. And there were already indications within our market that some insurers were going to do a mass cull. I think one of the insurers had done 25% off limits across the board. And the government was rightly concerned, as were businesses, and businesses were lobbying. Now, Tokio Marine HCC, we've never taken an approach of mass cull of limits. We didn't do it in 2008. We were managing to ride that storm, and we had no intention of doing it during the pandemic either. So when the ABI was starting to ask for data as to, what are the levels of cover that are going to be withdrawn, we were actually submitting a nil return because we weren't planning on doing a mass cull. So in that respect, the scheme was less significant for us. But there were a number of things to consider, and there were a number of stakeholders, and everybody's position was slightly different. So our customers are incredibly important to us, and it was really important what we did was what we felt was right by them. And we need to remember that credit insurance isn't just about insurance. It's a very valuable tool, particularly to SME businesses, in terms of guiding them towards businesses that they can trade with confidently, knowing that if things go wrong, the insurer is behind them. But really what our customers want is to enter into long-term trading relationships and not to trade with businesses that may not be around in 6 months, 12 months or a year. So we took our responsibility to customers extremely seriously. And one of the issues with the government support scheme was that it took the control of risk underwriting a little bit out of the hands of the underwriters and set out some rules as to when you could and couldn't withdraw cover. And we were pretty uneasy with that approach. We wanted to retain the control, and we believed we could do it sensibly. So that was one of the core reasons. And of course, if a customer does trade with a business that becomes insolvent, they're left having to pay the uninsured percentage of any claim, which is typically about 10%. And the claim could then also mean that their future premiums increase. So for our customers, we're a little bit nervous. And I would say that, it depends where your customers are. In some sectors that were very heavily impacted, so hospitality and retail, then the scheme may have been more significant. But for our own book of business, it was quite significantly skewed towards construction. And the construction sector was perhaps not going to have quite the same issues that other sectors would have done. We're also concerned about the broker impact, and brokers are very important to our business. They do provide, most of the new business cases, and they're very supportive of the insurers. And we were concerned about, how we deal with what potentially could be, a cliff edge as and when the scheme would unwind. And we didn't want to give them that uncertainty. And the way that, we were able to underwrite, it gave consistency that what we were doing before the pandemic was what we were doing during the pandemic, and is what we carry on doing after the end of the government scheme. But I'd say the real tipping point for us, and I quite vividly remember the ABI conference call we had, was when Milo had some conversations with Bays, and Bays had been looking at what the other European countries were doing in terms of their schemes, and the scheme shifted from a scheme that was going to be us paying over 90% of premium and retaining 10% of claims, to handing over 100% of premium and still retaining 10% of claims. And that just seemed that, it was a guaranteed loss. If you sign up to this scheme, you have a guaranteed loss. And that's not a very exciting proposition to, the insurance company and the shareholders of that particular business. So believing that we could continue to write credit insurance sensibly, we could support our customers, we could support our brokers. We felt that actually it was a better decision for us with our portfolio to not be in the scheme. And the final consideration was that we didn't actually think the scheme was in place for the right period of time. Now, it would have been great to have a crystal ball at the time, because we were all thinking in March 2020 we were going to have a tsunami of insolvencies and claims hitting us. And it just didn't happen. Everything turned out very, very differently. And even, as the scheme ends now, when will insolvencies increase? And I think that's a question for later on in this session. But, maybe the scheme wasn't for quite the right period.
Great. Thank you, Jane. A very comprehensive response. I've just got one follow-up question on that. The fact that Tokio Marine HC wasn't part of the scheme, did this materially change your underwriting approach during the pandemic?
Not at all. So we were very confident of our portfolio of risks. We'd already done quite a significant exercise in the 12 to 18 months prior to the pandemic, not knowing it was coming. So our book of business was, it was good quality. We were very comfortable with the risks that we were writing. And we believe that with, some extra effort, and it was a lot of effort from the risk underwriting team, that we could continue to underwrite in exactly the same way throughout the pandemic. And that's exactly what we did. And when we look at the levels of cover we were writing in March 2020 compared to what we were writing in March 21 and even now, overall those levels of cover had not really changed.
Great, thank you. Okay, Ava, if we can come to yourself, please.
Yeah.
Clearly, one thing insurers agreeing to the scheme with the government, but that's not the full picture, is it? So there's also a reinsurance treaty sitting behind most insurers. So can you give us a bit of a flavour on what was the sentiments of the reinsurance market of the scheme being put in place, please?
Yeah, absolutely. I think, the thing to remember is that credit and political risk form a relatively small part of reinsurers' exposures. So the reinsurers were looking at that time very holistically at the whole market across all their business lines. And obviously what was happening was massive contraction in global trade. There were predictions of catastrophic losses from some banks, quoting 40, 50 billion losses for the credit insurance market alone. So that's sort of the setting the background. But at the same time, there were losses associated with the COVID pandemic. For example, events cancellation, contingency cover, business interruptions. So the reinsurers were seeing losses rising, although, of course, as we now know, for the credit market, those losses did not really materialize. Reinsurers' role is really to support the cedants. So what they are underwriting, rather than specific risks as an insurer would do, they are underwriting the insurer's risk management. They are basically looking at how they write their business. They're looking at their business plans, and that is what they're supporting. Generally, the approach is to follow the fortunes of the underlying insurer. So the reinsurers completely accepted decisions of their cedants either to join or not join in some cases those schemes. What I would say is that the whole turnover market generally, the large whole turnover carriers did accept schemes, not just in the UK, but in Germany, in Holland, etc. So reinsurers did ask a lot of questions about it. They really wanted to understand how the split is going to happen, not just, as Jane says, in terms of premiums, but also in terms of risk, how risk will be ceded, and also to anticipate what impact that was going to have on premiums declared through the treaties. Most credit insurers have quota share policies where basically the reinsurer takes a percentage of the risk for the same percentage of the premium. So obviously, if the government was going to benefit from a lot of the premium income, that was going to impact the reinsurer's own premium estimates, but also exposures, which, at the time there was obviously a lot of query, a lot of uncertainty about how things might end up. The renewal season was interesting. Most reinsurance policies renew at 1/1, but we also have some 1/4 and 1/7 renewals. Right at the start of the pandemic, obviously the 1/7 renewals were the most exposed to uncertainty. The 1/4s were a little bit too late. And then, of course, the 1/1s as well, and seeing how things progressed throughout the year. The great thing is that there was, unlike in 2008 and 2009, when there were reinsurers leaving the market, we haven't seen really any of that. What we haven't seen is an influx of capacity into the market. Reinsurance capacity really follows what happens in terms of premiums, rates. It's also very sensitive to capital allocations, and credit insurance is one of the areas which does require a lot of capital to be allocated. But where we have seen big premium rises in contingency, in business interruption, even aviation and marine, that hasn't really happened in the underlying credit insurance market. There were some premium rises, but not really comparable to those other lines. So we haven't seen a new reinsurance capacity coming in. But as I said, at least we haven't seen reinsurance capacity going out either. And most renewals were kept fairly stable. Reinsurers take a very long-term view of their relationships. That is something that is really important both to cedants and to the reinsurance. Insurance is a long-term business. A lot of political risk business can be very long-term in itself. So people don't tend to jump in and out of those relationships. So I think the reinsurers wanted to see more in terms of price rises on XOL programs. There have been some rises, perhaps sort of around 10%. Ceding commissions on quota share business did reduce between somewhere around 1% to 4%. But generally, I would say the market has been very stable.
Great. Thank you. Thanks for that insight. I just got one follow-up question on that. I mean, you mentioned there about the lack of premium filtering through because of the government scheme. I mean, did you find during the renewal programs that the reinsurance companies were more restrictive in certain areas, or because of the long-term view that they take, they were just actually, there was no restriction?
What I would say is that there has been more scrutiny of the non-traditional business. So, for example, non-trade business. So perhaps looking more at the composition of the underlying products within the treaties. But generally, no, I would say the market has been very supportive. Generally, premium incomes dropped in any case as a result of the pandemic. So the reinsurers were already hit by that. And with some of those clients, those drops were very significant. Some Lloyd's underwriters literally put their pens down for a period of time when the pandemic first hit. So they have had the double whammy, if you like, of premiums, incomes dropping, and the government taking reasonable chunks, particularly in the whole turnover market, which is the largest market by far. But at least we haven't seen a rise in claims to exacerbate the issues to date. So I think the overall message from the reinsurers has been very positive and very supportive. Obviously, depending on the underlying cedants' individual results, where they were poor, there has been some pulling back of capacity. But yeah, not a major feature of this year's renewals.
Okay, great. Thank you. Okay, Rian, if we can bring it back to yourself as the insured and the user as a product, is it possible you can give sort of our viewers sort of some feedback in terms of how the product worked for you? Was it good? Was it bad? Or any sort of pointers on the product?
No, absolutely. I mean, so the focus for McLaren Automotive when the pandemic first hit, and clearly very few of us got little warning of this, so straight into all sorts of disturbance and chaos. But the absolute focus, became on cash, and the old adage of cash is king is never more true when you're in a global crisis like this. So focus on cash and rely on the strength of your balance sheet. In addition to that, it was about working with our partners. So working with our dealers globally, but also our supply chain. It was about all of us getting through this. Otherwise, none of us would have got through it. So it was that partnership. And that partnership, for me, was very much underpinned by our trade financing relationship. So yourself at Markel and our partners at Aon, and also our trade financing partners, Bank ABC. Without that incredible support and that genuine flexibility to make it work, it would have been so much harder. So let me put that into perspective. So customers are working, our ultimate retail customers are working with dealers. Their experience had obviously been extended, so they've ordered a car. That car would have taken longer to get to them because of global supply chain issues and extended logistical problems getting cars to market, dealers being closed. All of that meant the cash life cycle was extended. Now, normally that would cause huge problems, but because of our credit insurers, yourself at Markel, and then our trade finance partners at Bank ABC, that flexibility that you gave us to work with our customer base, our dealer base, meant that we could get through that and continue to offer the extended credit that was required. But then equally, we knew we had a great responsibility to maintain the strongest possible relationships with our supply chain. So as soon as we would get cash in, we made sure that our supply chain were paid immediately to make sure the cash cycle was working properly. Now we know that many of our key suppliers use credit insurance to ease the cash flow. For example, when they invoice McLaren for their parts, they will use credit insurance and trade finance to release cash early. So again, we would work with our suppliers' trade insurance partners to make sure they understood our business, how we were working, how we were operating, to give them as much confidence as possible. So quite honestly, the challenge would have been 10 times the challenge if it hadn't been for the way that you and our finance partners were able to work with us. So it was entirely good.
Good to hear. Thanks. Okay, so maybe from some points from the insurance side now, maybe Milo, Eva and Jane, the scheme is coming to an end tomorrow. Clearly it's been a benign environment in terms of claims. Can we have views from the insurance side on if the scheme was a success or not? So maybe Milo, can we come to you initially?
The short answer is yes. The longer answer is basically, I think what the goal of the scheme was to protect economy and make sure that we as insurers, thanks to all the uncertainties, didn't withdraw cover, making sure that the economy would remain alive and viable. So I think that's something I think we managed to do. It's the levels of cover. Governments even said it this morning. We're at a higher level during the pandemic than they were before. And currently, I think the levels of cover are higher than before. So that's basically what we aim to do, is bridge that gap on the decrease in the economy throughout the scheme. So from that sense, it worked really well. What we didn't anticipate was a tsunami of insolvencies, and those didn't come. So it meant that in the end, for the industry, it was a very costly operation. As Jane said before, I think we see that 100% of premium, and we would get in return 90% of claims. And if there are no claims, then you see a lot of premium without that return. So from that angle, I think it was a very costly way of getting a success. But on the other hand, I think the behavior we would normally have shown, at least I think I know from a Euler Hermes perspective, we would have taken quite some strong actions within our book. It's maybe also to explain a little bit, our portfolio is a little less skewed to construction. We got a little bit these industries which were affected a lot. So that meant that I think we would have taken out quite substantial level of cover, and that we didn't do. So from that angle, I think, yes, it definitely has been a success, but it's been, it came at a cost, which is, I think, fine, because we anticipated that. Either we would get cost through the level of claims we would submit to government, which in the end is also costly to us, or would come from the fact that we see the premium without the claim. So we ended up with a loss, as Jane says, anyway. But that's how it went. But yes, it is a success from my point.
Great, thank you. And Jane, while not being part of the scheme, do you have a view on the success of it or not?
Yeah, so I think if we look at the scheme in its entirety, and particularly what it did for the trade credit insurance market, then reputationally it was extremely successful. If we think about what happened in 2008, and we got a lot of bad press then, a lot of confidence was lost in credit insurance. I think the way that the insurers responded this time round and with this particular scheme, I think the reputation of the industry is in a very, very good position. So that definitely makes it successful. It did serve its purpose in providing stability and ensuring that credit limit coverage remained. So we didn't need it, but others did, and it absolutely did fulfill that purpose. And if you're the government, hugely successful because it was very profitable.
Yeah, absolutely. Eva, do you have a view on this, or the success of it or not?
I would absolutely agree with Milo and Jane. I think it has been a great success. It's obviously one of many actions by the government to reduce the impact of the pandemic. We've seen changes in insolvency legislation. We've seen extensions of payment terms. We've seen expanded roles of ECAs. We've seen huge unprecedented global monetary and fiscal stimulus. And this is obviously one of the ways in which the government has prevented a huge rise in insolvencies, with all the consequences of that, rising unemployment, et cetera, et cetera. So, and I think for our industry, it has been very good. I think it's improved the reputation of our industry. I think working with the government in such a positive fashion that Milo described is also good for the industry. And at the end of the day, it's all about the client.
Absolutely.
It's about you.
Yeah, and it absolutely works.
If it's secured the ability for you to continue to trade in unprecedented economic conditions, that's the clear
It did its
result.
job. Yeah,
exactly.
Absolutely.
Yeah.
Can I add a little bit, Simon?
Yeah,
to
sure.
I think one of the elements which was fair to say by Jane, I think we were anticipating on creating a cliff edge at the end of the support of the government, and I think what happened over the last 4 months, with the more certainty we got, with the more knowledge about what would happen in the economy, which were the most affected sectors, I think we managed also in the end of the scheme that there isn't a cliff edge. So the great thing is that with what has been going on, that the customers are protected, the buyers have been protected, or the customers from our customers have been protected, and there is no cliff edge. So I think that's also something we need to acknowledge, that the scheme in the end also worked well for the insurers, which we do it for. So I think that's something which was to me quite unique. In the beginning, I thought we were just kicking the can down the road with all the government support, but it's not. I think they honestly prevented a lot of insolvencies to happen, and the way they helped out the economy, I think, and I should give that credit to our government. I think they've done an excellent and amazing job there.
Yeah, great. Thank you, Mio. Rian, bringing it back to yourself. I mean, the UK has a strong automotive manufacturing industry. Now, as we're almost getting back to a bit of normality. How do you foresee the automotive industry in the UK over the next 12 to 24 months? Are you starting to get back to a bit of normality?
Yeah, I think we will. I mean, one positive upside from the whole pandemic is that there's a lot of wealth creation, and I think people's personal balance sheets over the last 18 months globally have strengthened. So certainly from the luxury goods perspective and the luxury automotive sector, there is strong demand. So I think that will continue to grow. But I think more generally for the automotive industry, I think there is a significant pent-up demand that will release, and I think we will start to see a significant bounce back. But also, there's this sort of confluence of we're just about to embark on an automotive revolution as we transition from the internal combustion engine into the hybrid era, and then ultimately into the pure electric era. Whether that's battery or it's fuel cell or all sorts of, whatever the different powertrain types will be. So, it's an exciting time for the automotive industry, and a lot of people are engaging clean energy, clean tech. And I think the demand is going to be there. And I think Britain will play a strong part in that.
Thank you. Good to know. Okay, just checking on time. We've got about 7 minutes left. I'll just quickly, if I can ask Jane and Milo, in terms of now at the end of the scheme, obviously we have one insurer in the scheme, one insurer not in the scheme. How do you anticipate your own organisations to perform over the next 12 to 24 months? Do you think our industry is going to be aggressive, and is now a right time to look at trade credit as a policy, given that we've obviously, some of us have lost some premium? We may be looking to claw back some of that premium. Maybe I can point that to Milo, to you first.
I think there's always a good time to start with trade credit insurance. So, but I think yes. I think the competition is good. So what we also noticed during the time of the scheme, I think that's something I think the government did well. You were not allowed to credit on the scheme, but you're also not allowed to take higher premiums. And so there was a good way of balancing how we should behave in a competitive manner, in a good manner. And I think that didn't change after the end of the scheme. I think for now, it's a very good time to start. And also maybe reflecting on where we are with the insolvencies today. I think we are 38% lower than last year at the same time. I believe that we will bounce back in economy. So our GDP will grow this year by 6%. But also I believe that we will have some more insolvencies, but not to the level where we were in 2019. I think it'll take another year to get to that level. So, and at that level, we thought that was a quite benign environment. So I think the number of insolvencies, I'm going to predict for the next 24 months, it's at a level where we would say we're able to manage it really well. Of course, there are certain sectors which have it more difficult, and some people talk about zombie companies. But on the end, I think we always have zombie companies around, who are struggling and manage to get through it. So to me, I think it's a good time. It is a time of growth. That means that I think you will have a lot of uncertainty. You will have a lot of new buyers, a lot of new customers. And there we can play a pivotal role. So to me, yes, it's an excellent time to start with trade credit insurance. And competition is there. I think we like each other in the trade credit committee, but as soon as we are out of the committee, I think we're just competitors and we do really well together to win a case from one another.
And neither of us are competitive, are we, Milo? So that's right. Jane, what about yourself?
Yeah, so I pretty much agree with what Milo has said there. I mean, rates are, pretty low at the moment, so a great time to buy. And if we remember that rates in trade credit insurance normally follow the pattern of insolvencies, when you've got insolvencies at levels that we've never ever seen before, you can expect the rates to be pretty low, and that's made the market, I think, extremely competitive. So a great time to be buying credit insurance, and particularly bearing in mind that this is the point at which a lot of businesses are seeing their turnover start to increase, and perhaps the opportunity to trade with new companies. And that's exactly what trade credit insurance is for, to help them grow safely with those businesses. So definitely a good time to buy. In terms of what's going to happen next, well, it's a little bit hard to know, but I think we've probably got 12 to 24 months for things to unravel and to understand, what normal actually looks like. The government schemes are being extended, and until we get to a point that there is no reliance on government schemes, it's hard to know really what the true state of the economy is. But like Milo, we're not expecting a tsunami of insolvencies. Yes, insolvency levels will at some point increase, but given that they're 40% below, what we'd expect as normal, there is only really one way to go, but not a tsunami.
Good, thank you. And Eva, just back to you, given what's happened over the last 12 months with the government schemes, do you anticipate the reinsurance market to be a bit more aggressive over the next 12 to 24 months?
Well, the reinsurance market for credit and political risk is really quite limited. You're talking about probably 30 players, and you can compare that to the rest of the reinsurance market within Aon that deals with more than 600 reinsurance markets. So it is very limited already. I think the positive message from the fact that there hasn't been a huge hike of loss activity, and the fact that the market generally behaved very responsibly, we are hoping that it will attract more capital. We need to grow the number of insurers, the number of markets that we have to offer for our reinsurer clients. But generally, reinsurers are quite conservative in deploying their capacity, and it really is going to be about them following the underlying market. So no, I don't see aggression there.
Okay, great. We've got 1 minute 45 seconds left, so I'll try to wrap it up and say I hope our viewers enjoyed that discussion. I think the sentiment I'm getting is all pretty positive outlook here, and trade credit is definitely open for business. And what I will do, maybe we've got just over a minute left. I'll just throw one question out there, and apologies we haven't got to many or any, but we will give a response online. So what I will say, if anybody wants to answer this, to what extent has a slight stalling of the reopening of the UK economy put pressure on the 30th of June winding down date? Does the group anticipate problems down the line with this? Would anybody like to jump in on that?
I'm not absolutely 100% certain how closely related the two are. I think the government has always had to have a cut-off date. You know, all of these schemes cannot be indefinite. So I think now is the right time. We are reopening, and equally, you know, the scheme has served its purpose. So I think it makes sense to wind it down now.
Okay.
Yeah, I think it's a fair answer. I think we are at the same acceptance levels as we were before the pandemic, and I think that's without the government support. So for us, I think we're already acting in the last month and a half or so that there wasn't government support. You know, it takes time to work with that, and I think the whole industry is doing that. So I don't. That cutoff point is just a point to say, you know, it's now over. I think. And I think most cover will be in place. I know from Euler Hermes' perspective, we are now providing more cover than we did before the pandemic. So for us, we have grown, and that will remain there. So I don't think there's too much of an issue with that cutoff date going forward.
You may be here beeping. I think that's time. So from me, I'd like to just say thank you very much for all the panelists, and it's obviously taken time out of your day. I really appreciate it. And Milo, thank you for joining us, and thank you. Hope you enjoyed viewing at home.